1, we start off kind of just from the very beginning basics. Where'd it go? There it comes. Very beginning basics of just the introduction to tax. Okay, what we're trying to do here is what is the overall purpose of why we're doing this. All right, so a lot of this, I will tell you right now, the very first 2 chapters are kind of just a little bit dry. Okay, we don't do a lot. We do a lot with marginal tax, effective tax, average tax rate. Don't let that kind of drag you down. Just kind of keep going with it a little bit. We'll get into the tax forms and everything, chapter 3. So the first 2 weeks are just a little bit dry. I tried to put problems in your homework so you weren't just asking or answering fill-in-the-blank questions, but you still have to know it. Even though it's kind of blah, you still got to know it. So we'll get through those first 2 weeks. So learning objectives are pretty straightforward. We're going to talk a lot about identifying the different types of taxes and what they are. And so then we kind of talk about who cares about taxes. And sometimes I talk about these slides and sometimes I don't, but this kind of cracked me up because of the next slide I'm going to show you. Businesses obviously care about taxes because they're applied differently depending on the type of business. Sole proprietors have their taxes come through their 1040. So it's just like you and I filing our tax return. Partnerships have it come through a K-1, which flows through their 1040, like you and I. And then businesses have to file their own tax return. But, you know, for businesses, it depends where they live. There's some states that are very friendly to businesses. And I don't know if you guys have taken Diane Maxner's class, ACC 213. I'm drawing a blank on the name of it. Survey to Business Taxes. Thank you. I taught it before her, but I cannot remember. Survey to Business Taxes, and then there's Business Tax and Research, which is the book he bought by accident, that really gets into the business side of it. And, you know, there's a lot of advantages. How do they compensate their employees? Because depending on how they do those things depends on how much taxes they pay. So there's a big difference. How much should they distribute to their owners? So who else cares about it? This is the one that cracked me up. Politicians, okay? Right now, I don't know about you, but you cannot turn on TV. I love my DVR right now because I record everything and I don't have to watch any of these commercials. I just fast forward. Our UVerse is acting up, and it's been acting up literally since March, and I finally called to get a new modem because I can't handle not being able to record shows because I can't watch any more political ads. But they do. They're distinguishing themselves from one another, or trying to distinguish themselves from one another on top of all the bad things they're saying about each other based on how they're going to do their taxes. Regardless of which one you like or dislike, or if you dislike both of them, they are distinguishing themselves how they're going to supposedly try to implement taxes when they get into office. So voters kind of have to have, if you're going to vote with knowledge, you kind of have to have a basic understanding of what they're saying. Because they kind of differ just a little bit, don't they? If you pay any attention, they kind of differ just a little bit on what they want to do from a tax perspective. And some of it might not be direct tax. Some of it's health care. Okay, health care has a direct effect on all of our taxes. So even though they're not sitting there saying tax percent, we're talking about health care, which has an effect especially on businesses' taxes. Who else cares about it? You and I. Okay, do you want to own a home? Your home can be your biggest tax deduction, right? All right, that's why we were joking when you said progressive and you'd say pay less taxes. Well, it does happen, and there's been jokes about why Donald Trump hasn't released his taxes, and there's a lot of people that don't. He's not the only person. But when you make a lot of money, you are able to take advantage of more tax deductions because you have more money to give. But there are a lot of people out there, and I'm not saying to him, there's a lot of people out there who make a lot of money and probably pay less taxes than you and I do, which is ridiculous. But it's because they have a lot of tax breaks, which takes their taxable income down. Well, you pay tax based on your taxable income, not based on how much money that you make. It's your taxable income. Right. So, and then when would you like to retire? All right, well, I have 3 kids and 1 kid who can't seem to drive a car very well. So I don't know when I'm going to retire. And then, so then we go on, what qualifies as a tax? Okay, we talked about this in one of your Learn Smart that popped up. A tax is a payment required by the government. tax repayment required by the government that's unrelated, all right, to any specific benefit or service. So it's not necessarily, we're going to talk about different things like use taxes and stuff like that. So key component, you have to be required to pay it for it to be a tax. You have to be required. It has to be imposed by the government, nobody else, and it's not paid to any type of benefit that you're going to get. Nobody personally can be benefiting that's paying the tax. So, here's a question for you. Which of these following constitutes the tax? So I'm going to give a couple things here. You tell me which ones of these constitutes the tax. What about when you pay for a driver's license? Does that constitute a tax? Ooh, what did I just do? Hang on a second, I just messed up. Does that constitute a tax? No. No. Why not? It's government issued, exactly. All right. Non-tax. Payment for required house appraisal. So the government is making you get your house appraised. No, why not?
Because you can directly benefit from
Exactly. I'm directly benefiting from the appraisal. I could directly benefit. I could also not directly benefit, but that's not the. I could directly benefit from the appraisal. Payment for hotel use of 1% of the bill paid to the city for projects. Yes. And if you've been to any city, including St. Louis, it doesn't have to be your big New York or Chicago, there's almost always what's called a city tax or a hotel tax or a use tax added on. So you got not only your regular taxes, but then you'll see a city tax and a hotel tax on top of that. And payment for a rental car use of 3% of the bill to pay for roads. Yes? It is a tax. All right, so it's tacked on to the car rental, which if you think about it makes sense. You have people coming in from out of state, possibly, renting a car, driving on your roads. You charge them for the tax. All right, so how do you calculate tax? We actually did this one also on your Learn Smart, right? Tax rate times your tax base. One of the most difficult things to figure out is someone's tax base. The tax rate's kind of easy. I gave you guys a chart, right? That's not hard. But how do you figure out what that number is that gets you to what that tax rate is? And when I say that tax rate easy, I have people all the time ask me, what's my tax rate? Okay, it's not like you can just say 35%. You have people that are in the 35% tax bracket, and you might be in the 28% tax bracket, but everybody wants to know, and because it's taxable income and it's not what you make, it's not necessarily just this cut and dry number. And if you look at the schedule that I gave you guys, notice how they kind of go through when you're looking at the schedule. And it talks about if your taxable income is over $91,150, but not over $190,150, and you're single, you take $18,558.75 plus 28% of the excess over $91,000. Right, now that seems like a really complicated way of looking at it, but you become very good at figuring that number out. So there's different ways to measure, and these were the three that I told you. I think the most common one, you're going to hear people talk about the marginal tax rate, but the most common one you're going to hear about is the average tax rate. Right, average tax rate is the average level of taxation on each dollar of taxable income. What's the average amount of tax that you pay? And that's what most people want to know. What's my average tax rate? Marginal tax rate applies to the next additional increment of income that you were to have. So it's a financial accounting number that we like to know, but not so much what everybody else wants to know. And then effective tax rate is the average rate of tax on each dollar. So those are the three numbers we like to mess around with. So to figure something out, let's look at tax rate example. Bill and Mercedes have $160 of taxable income. Most of the examples you have will be higher dollar. One of the reasons is in order to make these charts useful, it's usually up in the higher taxable income. So $160,000 of taxable income and an additional $10,000 of non-taxable income using the 2015 married tax rate, which is what we have. What is their tax due, average tax rate, and effective tax rate? If they receive an additional $80,000 of taxable income, what's their marginal tax rate? So first of all, how do we figure out their average tax due? What's their taxable income that we're going to use to figure out their tax rate? That's the $160,000, yeah. So the $10,000 is non-taxable. So we're going to have the $160,000, and we're going to go to your tax rates, all right, which I'm talking, so the online students would find this on Blackboard or in your book. So he's married, filing jointly, income is $160,000, so that's going to be the third one down. So it says $10,367,050 plus 25%, plus 28% of the excess over $151,900. Did I look at the wrong one? Oh, I was looking at single. No, I wasn't. Yes, I got the wrong number. Sorry. I was looking at single. All right, I take that back. So looking at married, it's $29,517. Yes, $29,517.50. And then the other two numbers I did have right. Plus 28% of over the 151.9. So you'd subtract the 160, 151.9, multiply that times 28%, and add it to 29,000, and that gets your tax rate. That's just your flat tax due. And his tax due is $31,785,000, which is exactly what we do. Does anyone have a guess on how we figure out what's the average tax rate? So the next two that they want, so this was your tax due, and then they wanted average. Let's see, they wanted average and they wanted, I can't pick up, effective and marginal. Oops, well there you go. Okay, there's average. All right, so to do average, you're going to take the tax due divided by their amount of income. All right, that was going to figure out their average divided by, oh, sorry, not their average. You're going to take their tax divided by their income. Do you have any problem?
Huh?
Do you have any problem?
I couldn't return it yet. The lady's not there, the manager.
Okay.
I'm going to wait tomorrow.
So you take the tax, so it's going to be the $31,851 and divide it by the 160. And that will give us our average tax rate. Now the effective tax rate adds an additional calculation. The difference between the average and effective is you do have to include the $10,000 that was non-taxable. It includes all income. All right? So the difference here is you're still going to take your tax that we just calculated above, but we're going to take the 160 plus the 10,000. And then the last one, the marginal, I don't want to flip back through the slides, but the marginal, one of the things they said, what would happen if they had an additional, I think it was $80,000 of income. So what the marginal is going to do is kind of have a what-if scenario. What if we had another $80,000? What would our tax rate be if we had another $80,000? So what do you think we're going to do? What do you think happens to our income that we've been having on the bottom part of this? If we had 160, what do you think we're going to do to it? If we had 160 and now we say instead of 160, we're going to make another 80,000, then we're going to look at it based on 240. We're going to take the 260,000 and we're going to add it. And the difference is we're then going to subtract so we can see what the difference is. Now, anybody know what that 54,279 is? This number right here. Oh, my pencil's not working. Anybody know what that number is?
Probably the tax would be figured on the higher income.
Exactly. All right, the tax on that number is the higher income amount. So this number right here, the 240, is going to be 54,279. 160 tax is 31,785, which we already knew. So subtract the difference between those two, subtract the difference between those two, divide them, and your marginal tax rate is 28%. So the average tax rate is telling you, normally your tax is going to be roughly 19.87% on your taxable income. So if you're trying to figure out how much tax you're going to pay, it's going to be roughly 20% of your taxable income. Your effective tax rate, all your income is roughly 18.7. And then your marginal is going to sit there and look at what would it be in a what-if scenario. All right, our tax rate structures, and we did talk about these a little bit when we were already walking through LearnSmart. So the proportional, flat, progressive increases like we talked about, and regressive goes downwards. We are progressive. This just kind of gives you an idea looking at a graph. Pretty much they're opposites of each other. All right. And like we talked about, we're progressive. Most countries are proportional, where they just kind of keep flat amongst everybody. Now let's talk about the different types of taxes. So federal, everyone knows about the income tax. Then we have employment and unemployment taxes. Now most of us in Missouri don't necessarily know about unemployment taxes because we don't have to pay them, which is nice, but our employers do have to pay them. In some states, you do have to pay unemployment taxes as an employee also. It just so happens in Missouri we don't. They can range anywhere from 5.4% to 2.2%. It depends on what your company has to pay, depending on what you might have to pay. You got excise taxes and you have transfer taxes. Then you have state and local taxes. Sales and use tax, which we already talked about. A use tax was like the hotel or the rental car. You have property taxes. If you own a home, that's not property. That one's called what? What's the difference between property and real estate? Real estate's when we...
Property is like cars and...
Yes. Property is going to be cars, boats, trucks, motorcycles, ATVs, anything that's above what would go in your house, basically. And real estate is going to be when you physically own land or something that goes on the land. Sometimes you can have real estate taxes without owning land, an example of a condo, or something like that, but you would pay taxes in that example. And then we also have excise taxes and income taxes. And then we have implicit taxes, which we were talking about. Income taxes, approximately 56% of all the revenues collected in the United States. So when you look about that, if you think about the amount of money coming in and any changes to our tax structure, how anything dramatic would affect the revenue structure would be huge. You also look at individuals contribute 46% of that 56%. So if you haven't already heard of the 80-20 rule, this is the 80-20 rule. The 80-20 rule is that 80% of the company, 80% of businesses in the U.S. are made up of small businesses, 20% are corporations, but yet corporations make up 20% of the income and small businesses make up 20%. It applies, if you take it on the tax side, 80% or more of the taxes come from individuals, 20% come from companies. But yet companies are much bigger from the standpoint of what's going on. So it's definitely kind of out of, I don't know, it just, when you look at it like that and you double it, you got 80% of the revenues coming from us, individuals, and 20% coming from corporations. They can also be levied on estates and trusts as well. And employment, which I talked about, is the second largest group, employment and unemployment. And they also include in that a Social Security and Medicare, which we all pay. Hopefully you know a little bit about them. We don't go into the details necessarily of them, but we do talk about the fact that they come out, and we talk about where they will go. You do have to do self-employment tax, and we do talk about that because we do talk about businesses. We will do a Schedule C, and so we do talk about self-employment taxes. Excise taxes is a third, and this is levied on the quantity of the product. All right. And then estate and gift taxes is the fair market value of wealth, and this is at the bottom, and this is transferred upon death. You know, you can also do gift taxes. Gift taxes is when you're lucky enough, as I like to say, to have enough money to give more than what you're allowed to give per person. And I believe, and I have actually not looked this up, last year it was $14,500 is what you could give per person, per individual in your family, without paying a gift tax. So for example, if my parents were lucky enough, they could give, each of my parents could give me $14,500 each, so $29,000, without having to pay a tax on it. And then they could give my husband $14,500 each, and each of my kids $14,500 before they would have to pay tax. If they chose to give us $30,000 each, they would have to pay a tax on an extra gift tax on the extra $1,000 they gave us. This tax has been put into place basically from wealthy people for basically gifting their money away to their children and other individuals so that they did not have to pay tax on death. So you can't gift away all your money when you're dying. You have to pay tax on it. All right, state and local. Tax base for sales tax is retail goods. We all pay that. All right. And then there's also a use tax that were not consumed in your state. So the use tax usually is when you're trying to get tax base for items that either were not used in your state or for people that were not in your state coming to your state. One of the two things. So not all states have sales tax. Does anybody know of a state that doesn't have a sales tax?
Delaware.
What was that? Montana? Yep.
Delaware, I think.
Delaware? I think that's correct.
Texas.
Oregon? Yep. Texas doesn't have a state sales tax. That's correct. But that's, on their, wait a minute, back that up. They don't have a,
Yes.
yes. Okay, I was looking at, they don't have a state tax, not a sale. They have a sales tax. They don't have a state tax. So that was on the one we just did. So they don't have a state tax, but they do have a sales tax. And there is a difference. There's like 18 states that don't have a sales tax, and there's 11 states that don't have a state tax. So which one does better? Well, it depends on how much shopping you do. All right, it really depends. If you are someone that works on a regular basis every day, then and you have a decent salary, then not having to pay a state tax on your payroll is going to be very nice. If you're retired or unemployed, then you really don't care that there's no state tax, and you would rather have no sales tax. So it really just depends on the way you look at it. There are people that have said there's talks that Missouri is trying to get rid of their state tax, and on the top, most people love it. But the one thing you got to think about is if they're not bringing in a state tax, what are they going to do to recoup the money that the state tax was bringing in? Because Missouri is not making a whole bunch of extra money that we're spending on things. So I'm all for it. I would love not to take out that extra money in my paycheck, but where are they going to make that extra money that's going to pay for what things are going to pay? What?
Sales tax.
Sales tax, but we already have, does anybody know what Missouri sales tax is? It's close to 10 in some areas, but the state sales tax is actually 5.4. The 10 in that is in different areas with all the local taxes that are added on. So in areas that's already 10, how can they up it even more to account for the 5% sales tax? I mean state tax. Then you're going to have people not shopping out in Chesterfield because it's 15%, right? So it's not that it can't be done, because obviously 18 or 11, I get my two confused, don't have it, so they figured it out. But a lot of the states that don't have a state tax are tourist states. So they bring in a lot of people. They got use taxes and they got sales taxes. They're not a huge tourist state, so you might need to try to bring that in. Property taxes and real estate taxes, and then we have personal property taxes. Personal property taxes, are a little different than property taxes, include all other, both personal and tangible property. And then we got our income taxes, which is one we already talked about, and excise taxes on income that is imposed on the federal level. And then the implicit taxes are indirect taxes that result from a tax advantage that you got from the government tax. All right, so they're not always straightforward. They're not always something that you know you have to pay. They're defined as the reduced before tax return, and it's difficult to quantify most of the time. We talk a little bit about these. We don't go into a lot about the implicit taxes. All right, and then there is 5 different ways to evaluate the different tax systems. The 5 different ways, the sufficiency evaluates the aggressive size of the tax revenue. All right, is your tax system sufficient to handle the amount of revenue that you need for whether it's your state, your local, your government, to provide the different revenues and to cover your funds that you need. The equity is how the tax burden should be distributed. That is something that is the ongoing political argument that we have going, and what we're hearing about right now is how should it? Should it be progressive or should it be proportional? And I'm not sure anybody running for office right now says proportional. I think they're just disagreeing on what is actually progressive. All right, certainty means that everybody should be able to pay the tax. And that to me is what the interesting part is. Okay? It doesn't say that everybody should pay the tax. Everybody should be able to pay the tax. All right? Where they pay the tax and how they determine to pay the tax are 2 different things. But everybody should be able to pay the tax. And then convenient, it should be designed to be able to collect without hardship. That's funny, okay, because I don't know that that's ever happened. And economy, it's compliance and administrative costs associated with the tax system. Now, our IRS, they say, is about 7 years behind being able to have the IT systems to keep up with fraud and everything that it needs to today. So a lot of times when I look at the different things with the IRS code and everything that we have today, and you look at sufficiency, I said equality, equity, certainty, convenience, and you look at how the IRS is set up, it kind of makes me laugh a lot because it doesn't really seem like the 2 match up very well. But a couple things you got to keep in mind. Number 1, when the IRS was first set up, it literally had a room smaller than this where the tax code was like 4 books. All right. I'm not sure the tax code could fit in this building. There are so many different rules and regulations. When I tell you this is open book, sometimes people on the tax side for the CPA exam have argued that the tax CPA portion should be open book. That nobody really knows tax without looking things up. You know, if you go into the partner or Reuben Brown or Ernst & Young, yeah, they're going to rattle things off. I mean, they definitely know things. But they have books and they have reference guides all over their office because there's just that much information that you need to know. So there's just an abundance of information of tax law and tax information. When you call, and I've done this myself, when you call and get irritated with the 1-800-283-1040, okay, which is the number to call the IRS, you could be talking to her. Literally, you could be the person answering the phone. You could be an IRS agent with 2 weeks of training. That's who works for the IRS call centers. You are the person I've yelled at, okay, and I have yelled at them. And I know better, and I still get upset with them. It doesn't mean that it takes anything away. You're still mad, okay? And I usually apologize when I'm done yelling at you, but it gets upset. But that's who goes to work. 1, because it's a government agency that's not paying you very much money. So CPAs are not going to go work for them and answer a phone, all right? And 2, because it's still a government, right? They just don't pay anybody very well. So the IRS is backwards in a lot of different ways. And so when you look at these 5 different things, they're kind of backwards also. Now, it doesn't mean they can't change. It doesn't mean our system's all messed up. In a lot of ways, it's very good. They've made a lot of progress. I mean, our VITA program, which you'll hear me talk about throughout the semester, just in a few ways, it's in the spring. We only do it in the spring, and it's on a Wednesday. So a lot of times, night students can't do it because you guys have jobs. But it's a volunteer income tax assistance program that runs on Wednesdays. Zaid did it from 1 till like 5:45 or 6, where we teach you how to do taxes. So he learned that. And then starting about the 5th week, you do tax returns on Wednesdays for low-income, elderly, and students in the community. So it's a class where it runs from the first week of spring semester until April 15th, where we're doing the taxes. And when we're doing the taxes, 2 years ago, we had a fraudulent tax return for identity theft every week. And it was the year that fraud took off. It was just ridiculous. Last year we had 1. So it's not that people aren't trying to steal your identity, it's just the IRS did get better at preventing it. They picked up the pace, they did put some things in place where people weren't able to process your return without some information. And a lot of it was the way that they handled processing tax return. So things are good. It's just the way we evaluate, the way we do returns has to get better too. So, and one of that is by getting more and more people into accounting that have the right background. And that is something that I'm not sure why a lot of you guys are taking this class, but I will tell you that in the next 5 to 10 years, we're going to have a very big shortage of accountants, especially educators in accounting. Because most of the educators, even though our department's extremely young, are going to be retiring. And so every conference we go to, Marcus and I go to quite a few, that it's the biggest thing is that the number of people going into accounting for some reason isn't as high. And I got to tell you, I tell my day students all the time, 2 things that you're never going to change. You're always going to need accountants because you're always going to need people to do taxes, and people don't understand it. And you're always going to need doctors. Those are the 2 things that are never going to go away. And so 2 things you can be sure of. And it's just, if you're in here for just because, or because you're getting an associate's degree and tax was just one of the things you took, great. Or if you're in here because you're going to accounting, think serious about continuing on. Hopefully you like this class. Some like tax, some like intermediate, some like more the business side. Sometimes tax might not be your thing, and that's okay. Accounting in general is just a good field to kind of stay in. So that is kind of